So, welcome everyone. I'm really happy to be on a call with Chad Hailey today, who is a insurance broker, for want of a better term, insurance agent. I'm obviously from the UK, not from the US, as you can tell from my accent. So we tend to say broker in the UK, but one and the same. So I'm really excited to have you on and to grill you about infinite banking and how that works in conjunction with a private, non-statutory, irrevocable trust structure, which is the type of trust that I help clients set up to build generational wealth. And yeah, uh, Chad is my go-to man when I recommend clients for this type of setup. So without further ado, let's get into it.
Yeah, I'm excited. Let's do it.
Cool. So, just give us a high level overview, Chad, of a lot of people have heard about like infinite banking or the waterfall method and doing it with some sort of insurance policy. So, what does that look like? What type of insurance policy does it specifically have to be? And how does that work hand in hand with the trust?
So the infinite banking concept for those that are new to that term or maybe have heard it but are not real sure what it is. What it is it's a concept of using a high cash value life insurance policy. Typically, it's going to be a permanent life insurance policy, not a temporary or they call it term life insurance,
Yeah.
but it's going to be permanent. We have always understood this method to work best with whole life policies. There are other types of permanent life insurance policies that people attempt to use. Whole life tends to work the best, especially when you're putting it in conjunction with a trust, an irrevocable trust like what you've been building out. What it's designed to do is it's designed to allow you. The reason it's called infinite banking is it's designed to allow you as the individual, as the business owner, to become your own bank, so that you're essentially able to self finance your entire world. And it's obviously it starts small, it grows over time, but it can grow very quickly depending on your structure and your contributions and a lot of different variables. However, the brass tacks of it is to be able to self finance not only for now, but into perpetuity. Really, with the irrevocable trust, you're able to create it so that it's constant and it's going to continue to pay itself out. And so when you structure it, the goal would be there are three parts to any insurance policy. There's the owner, would be part one. There's the insured, the person who's actually insured, because insurance has to insure an actual person. And then there's the beneficiary. Now, as long as two of those three pieces are the same, then control is had. And so in the perspective of a trust, the trust can be both owner of a policy and the beneficiary of the policy, which gives them control over the policy. Now, could be the insured could be the trustee, the insured could be the spouse of someone, the insured could be the actual, the business owner, or however you might, you as the individual, you could be the insured. And what happens is upon your passing, the beneficiary, which is the trust, would receive any death benefit that's available. So that's the basic structure. The cool thing is that there's so many other things that you can do with it, but hopefully that gives you a quick
Yeah,
basic idea of how it works.
that makes sense. So, in terms of like, let's say, let's for an example, let's say we front loaded the policy with like I don't know, like 50 grand, let's say, and then there was like a monthly premium paid into it, into perpetuity. Then what happens to to that money? Like, what can we do with it once it's inside the trust, inside the policy rather? And what flexibility does that give us?
Awesome. Yeah, great question. One of the things that we do is we really focus on making sure that the policy is structured properly.
Mhm.
Each and every family and business that we've worked with, it's going to have slight differences and variables, really depending and based on what their needs are. If I'm talking just basics about it, the goal of any infinite banking policy is to allow you to, if you put that 50,000 up front, and let's just say, for simplicity's sake, that the premium is $1,000 per month. First and foremost, I know that sounds like a crazy big premium. We're talking like homeowners premiums are not even that large. Don't look at it as though you're paying into a premium. Look at it as though you're paying into a high powered savings account with a ton of benefits. And so number one, when you're paying that premium each and every month that you pay it, you are going to have the ability to borrow against it, which means you can pull cash out as quickly as you put cash in. The way that we design the policies is for that very purpose, so that you create an opportunity fund for other things. If you front load with 50,000 and then you're putting $1,000 a month in, well, we may design the policy for you to have up to 90% cash value access immediately. And
Wow.
so and so you may get your policy in place, you put your 50,000 in. Let's say you put, maybe you put 2 months in. So
Mm.
you're sitting at 52,000 that you've put in, and you have access to 90% of that. Well, then along comes a real estate opportunity. And the real estate opportunity is, let's say it's $100,000 home that you're going to be able to turn into a rental very quickly. Well, you need $20,000 to put down on it. So you get that 20% mark, and
Mhm.
you've got that money in your policy. You can simply borrow from your policy, create your
Wow.
rental, and then
Yeah.
you can use the income from the rental to pay back the policy.
Yeah.
And the beautiful thing is that's a very simplified version of it, but it gives you an idea of what's possible. You may see an investment opportunity in a business. You may see investment opportunities in, who knows, maybe you're a speculator in cryptocurrency and you want to invest heavily in a new coin that's coming. There's so many different ways that it can be utilized, but that cash value gives you the ability to look around and go, what are the opportunities around me that I could actually make this money grow? And so you can use that as seed. Now, on the back end, that's the front end, that's the part that we see, and that's the flashy, that's the sexy part. On the back end, on the not so sexy side of things, what is happening is that every time you make a premium payment, it's recorded as cash value. So that cash value continues to grow. And you've got two buckets. So
Mm.
you've got bucket one is your premium bucket. That's the bucket that you put money into. So if after 2 months you put $2,000 in because you pay 2 months premium plus your 50, you've got 52,000 in this bucket. Well, these cash value policies have what's called a dividend that's paid out every year. It's 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 a small interest rate, if you will. That's the best way to kind of look at it. Look at it as an interest rate or a dividend that's paid to you every year. Now, it's based on the cash value that you've put in. So if you put 52,000 in, and let's say it's growing at a 5% interest rate, then annually, if 52 was all you put in for the year, then annually you're looking at $5,500 growth.
Yeah.
And it's going to be 55 and some change. But that's, you're looking at that kind of growth year over year. And each year that it grows, the next year it's going to grow a little more, and it's going to grow a
Mhm.
little more. But
Yeah.
you've continued to put premium in. So that cash value bucket never shrinks, it always grows. And then there's another bucket that matches your cash value. And that's the bucket that you can borrow from. It's
Right.
really, really cool. If these are structured right, what you get is, on one side, you get non interrupted compounding interest year over year until the policy runs out at age 120,
Yeah.
or the death benefit pays out. But that growth continues to be there year over year. On the other side, you have an opportunity bucket, so that and it matches your cash value. And when you borrow against it, you have one of two options. Once you've borrowed against it, you can, number one, you can set yourself up to pay it back, which is the wise choice to make, because you're paying yourself back. You have become your own bank. you are now borrowing from yourself and paying yourself back with interest. So, and when you pay yourself back with interest, you actually pay yourself more money. So it works that you're paying yourself that way. The other piece of that puzzle is that you can choose to go, I'm going to defer paying this back for a little while. Maybe you found a fix and flip home that you wanted to flip. You're going to fix it up and then flip it. Maybe it takes you a year to get that done. In today's market, that's not uncommon to see it take a
Yeah.
year to get a fix and flip flipped over and then put on the market and then finally sold. So let's say it takes a year. Well, you may not make one payment towards the loan that you took out until everything has been done and it's sold. And once it's sold, then you're paying yourself back. The,
That's really cool.
it is cool. It is cool. And on top of that, if there's an icing on the cake on this, these loans that you take out, those are non-taxable loans. It's a
Mm.
loan. Any loan is non-taxable, but these loans that you take out from your policy are non-taxable, which is really nice.
So, and also, my understanding is that there's no hoops to jump through to arrange that loan, right? It's just a
It,
request. It's not
it,
an
it's
application.
It literally is. And anytime I'm working with, especially if I'm working with a business client, or if you're using this for a business opportunity that you see, whether it be a fix and flip or, it's a piece of real estate or something like that, I always advise to, if even if it's just an agreement between you and yourself, because you're the borrower and you're borrowing from yourself, even if that's the arrangement, I still advise, hey, put a simple contract in place that explains the terms of the loan, even if the terms of the loan are what are just they're simply, this is what the insurance company said, if I borrowed from them, I was going to have to pay them back at 7% interest.
Yeah.
Great. So even if you all you're doing is writing a simple contract, write the contract up, because it really helps make sure that everything's protected on all sides. And there's a lot of creative ways that this can be done and it can be utilized so that you yourself, if you have a business, if you have your own LLC, that you're borrowing from your personal or from your trust, you want to make
Yeah.
sure that there's a contract between those two entities, so that it's done the right way,
Yeah,
and it's
exactly.
done with full protection. It's kind of a cover your hind parts, if you will.
Yeah. I mean, particularly from the trust perspective, we need to make sure that everything's done via the board of trustees rather than, being seen to be commingling any funds or anything like that. So
100%.
yeah, um, it's all about protecting yourselves, making sure you're not going to get yourself in any hot water.
Right. 100%.
Yeah.
100%.
So, um, in terms of like when you're out in the marketplace looking for these types of policies, what are some of the pitfalls that people need to be aware of to make sure they don't end up with something that's not going to best serve them and maybe serve the agent more than them?
Yeah, great question. And it's always the challenge, because I have friends in the marketplace who sell all different kinds of life insurance policies. Those of you that are paying attention today, I'm here to tell you that there are over 2,000 different life insurance products available on the market today. So for
Wow.
anyone to come to you and tell you that their type of life insurance is the only kind or the best kind, we've all heard the gurus out there say, buy term and invest the difference, or, the IUL is the only way to go. Whole life is the only way to go. The reality is, what works best for you is the right way to go. Now,
Yeah.
having said that, I'm going to give you a couple of things to be aware of and pay attention to. Um, a term policy does not give ownership in any way, shape, form, or fashion. You are
If you
borrowing life
policies,
insurance for the
yeah.
term of the policy.
Mm.
And yes, it may give you 500,000 or $1 million in coverage in the event something happens to you in that 10 or 20 or 30-year window in which you are renting life insurance. The hope is that it doesn't, because, well, the life insurance company doesn't want to have to pay that out. But in the event it does, there is coverage there. Um, they're not bad tools. You just need to understand how to structure them right for your
Mm.
future and not for the present. A lot of times people will sell it to you as though this is all you need right now. and then they're
Mm,
going to sell you on something else. That's the idea of buying term and investing the difference. 95% of people don't invest the difference. And so
yeah.
it's not necessarily the best strategy or the best fit.
Mm,
Number two, and I'm going to tell you this, whole life insurance comes in a lot of different forms as well. When you're looking for a whole life insurance policy that is designed to best fit the infinite banking concept. Now, there's a lot of different smaller strategies inside the infinite banking concept, but typically the plans that are designed are their plans with a non-direct recognition company. And what that means, I know that doesn't make any sense to anyone, but what that means is a lot of times you'll hear, of a mutual company, and you could probably, as soon as I say that, you probably think of several companies that have the word mutual in their name. Well, those are the types of companies. Mutual companies typically tend to be non-direct recognition. And the reason
mm,
that they are is because they actually partner with their policyholders. So they allow their policyholders to be considered members or part owner, have some
right.
ownership in the company. So like,
Mm,
with the policies that I issue, a lot of times I'll get asked about voting for the board of directors. Hey, we need to vote for a new board of directors, a new seat 7 on the board of directors or
yeah.
the board of trustees. And I'll actually get a vote in that. And so that means that they view me differently. They have a lot of clients who are not, clients in that regard. But because of the way my policy is structured, I am viewed as one of those clients that they're going to trust me
Mm,
to place a vote when they're doing those kinds of things. And so it gives you a different level of relationship with the insurance company. And because it does, that's how the infinite banking system works so well, is it gives you a different kind of access. I think it was American Express that used to say membership has its privileges. That was one of
yeah.
their taglines for a long time. It's kind of the same concept here. When you become a member of a non-direct recognition insurance company through the policy that is written, you
Mm,
actually have membership with that company, and they view you differently. And so you get different privileges, if you will, that come with that, different benefits. Um, so always make sure that whatever company you're using for your infinite banking system, make sure that they are a non-direct recognition company. And that's a question that you can ask your agent. Is this
yeah.
a non-direct recognition company? A few of the companies that I've worked with in the past that are, New York Life is a non-direct. Mass Mutual is a non-direct recognition. Lafayette is another one that's a really good one. There's a couple of others. Those are probably the big ones
Mm,
that we work with most of the time. They are able to handle most of the deals that we do. Sometimes we may see a little offshoot here and there. There are some smaller companies that still do it well and do it at a high level. They're just not as known for it.
yeah.
The final thing, and I'm going to say this with a big caveat, that the norm is, this is the norm typically, is an IUL. IUL stands for an indexed universal life insurance policy. It is a permanent life insurance product.
Mm,
It is attached, though, through an index. Index being the Fortune 500, the S&P 500. It's attached to an index, and so it has growth attached to it through that index. Now, what they tell you is that it has a great upside and there's zero downside. Now, you have to be careful with that, because what I've seen time and time again is the initial layout, the initial policy looks great on paper. They'll show you 30 years of incredible growth and incredible stability and all those things. But then when it comes to actually seeing that play out, we have yet to see an IUL that was given that had an initial layout where 10 years later we're looking at the initial layout and what's actually happened, and they're nowhere near the same. The cash value hasn't grown the way it said it would. The cash value is not available the way it said it would, and 9 times out of 10 they just don't perform the way that they're sold. And so what I would tell you is, if somebody is trying to sell you an IUL. It's a fine product if it's sold the right way. If it's sold as an infinite banking product, I don't think it works very well as an infinite banking product. So ask the question, can you show me a 10-year outlay? Like for real, a real 10-year outlay. I don't need to see names. I just need to know that this is where this person started. Here's where they were 10 years later. Does that match the initial outlay and the initial, basically, here's what we thought was going to happen and here's what actually happened? Because what you see is you see performances that just don't match up. And so I would just be very careful trying to use an IUL in the infinite banking space. And if somebody's telling you that it's a great tool to use for infinite banking, be very leery because they're just telling you something that isn't true. It doesn't mean it can't be used for that. It just means that they are trying to sell you a product that's going to make them more money than it's going to serve you. I'll be the first to tell you that whole life policies like what we typically tend to recommend for our clients, those policies pay us the least of all the policies that we put in place. So they're not crazy lucrative for me. Do they make me good money? Yeah, they keep food on the table and I appreciate that. But it's not about me keeping food on my table. It's about me helping families protect what they're building so that they can begin to create legacy wealth for not only their children but their grandchildren and gosh, even four and five generations on down the road. And so we're looking for long-term wealth generation, through families that really do have a desire to make a difference in the world. So, oh, Bradley, I think you may be on mute.
Sorry.
There we go.
I'm back. So on our checklist so far, we want to make sure it's not an IUL, so it's a whole life mutual insurance policy. And we want to make sure it's high cash value. Okay. Is there anything else we need to look out for to make sure that it's going to serve us best as trustees of our trust looking for this type of policy?
Yeah, I think that making sure whoever you're working with, whatever agent you're working with should take the time to sit down with you and understand what your financial goals are. They want to truly have a good picture and understanding of where you're wanting to go. Whether it's okay, I want to make sure that little Johnny's college is paid for. I want to make sure that my wife never has to worry if something happens to me. I want to make sure that, whatever those things are, we want to make sure that whatever we're designing, the infinite banking policy that we're designing, it if it goes inside a trust, if it doesn't go inside a trust, we want to make sure that everything is structured so that your goals are being met through the structure that we build. Because what I've learned in this business, and I'll say this because it's true, is not everyone needs life insurance to make
Mm,
things go. And not everyone wants that tool or needs that tool. So we want to make sure that number one, do you need the tool? Is it going to make a difference for you? And is it going to help move the needle closer to where you want to be? Most of the time it does, and it helps. It just really comes down to what are your goals and how can I help you meet those goals to the best of my ability. So whoever you're working with, that's one of those questions that if they're not asking you really and they're really not digging into what your financial goals are, then ask some questions. Make sure that you're working with someone who's going to help you get where you want to go,
yeah.
not somebody who's just trying to guide you toward something that's going to maybe put more money in their pocket, because that's not what we're here for. We're here to serve and to help the process. And so, I want to give you an opportunity for tax, not just tax deferred savings in retirement or when you get to retirement age, but how about tax
Yeah.
eliminative savings, where we don't have to worry about taxes at all? When you could start combining these irrevocable trusts with your high cash value infinite banking policy, with your income streams, with your LLCs, with all these things, and you start putting all this together, you start creating a mechanism that grows very, very well with very minimal tax. And they're very extraordinary, and you just want to make sure that you have all your pieces structured the right way, in the beginning, so that you're not faced with getting your tail whipped later on in life, and that's, I know we briefly hit on it before we started the recording here, but that made me think of one more thing, which was the MEC. It's called a modified endowment contract.
Yeah.
And with the high cash value insurance policies, there is a threshold, and it is different for every single person that enters into one of these. So it's hard to give you exactly where that threshold is. But there is a threshold, and we will find that before we implement your policy to make sure that we know exactly where it is. There's
Mhm.
a threshold that if you hit it and you go above it, then what happens is your policy does become taxable. We do not
Okay.
want that to happen. My job is to make sure that it does not happen. And so this is why we spend a great deal of time and care in policy design, because
Mhm.
number one, I need to understand what you want to happen. And number two, I need to make sure that what you want to happen can happen through the policy that we're putting in place. Or even if we're deciding that we're going to put one policy in place now, and then we're going to implement 1 to 2 to 5 more policies later on down the road to really make sure that we're on the right track. But that modified endowment contract is definitely something we want to make sure that we do not get ourselves into. So whatever
Yeah.
agent you're working with, make sure that they're aware that you do not want a modified endowment contract.
Does
And
that does that only apply to individuals though? The mix.
no, it can apply to if you're a business owner or you're a trust that owns a policy. It really how it applies is it applies to how much money you put in the policy.
Right.
So I've seen people be able to structure their policy to where they're able to put in $100,000 a year, and it
Yeah.
still doesn't become that modified endowment contract, whether that's through their business or through their individual efforts. But then I've seen people that are set up so that they put in $20,000 in one year, and boom, it turned into a mech. And so it is a variable based on, on the insured's age, on the revenues of the individual or of the business. So there's a lot of variables that go into where that threshold falls. And so my job is just to make sure that we stay within that threshold, that we're not going to push the envelope to get ourselves in trouble there.
Okay. Cool. So let's get into the nuts and bolts a little bit of like, what would this look like over generations? So let's say, you start the policy today, you build it up to say like, I don't know, $1 million for ease of numbers. My math's not that great.
Yeah, no, that's good.
And you've borrowed 700,000 of that, let's say, uh, and then you die, right? That debt's outstanding to back to the policy, right? What
Yes.
happens in that scenario?
So great question. And it is very simple. Thanks for using simple numbers, because it makes the math will math really easily in everyone's brain. So we've got $1 million death benefit that's been built up. We have 700,000 that we've borrowed against our policy. And so now, okay, and we passed, and so now we're trying to reconcile. Well, it really is a simple math reconciliation. 1 million minus 700,000 means there's $300,000 left in death benefit. And that's the part that pays out.
Right.
They use what came from the death benefit. They pay off any debts that were owed to the policy. The rest goes to the beneficiary. And if you've structured it properly, we're going to use one of the trusts as an example. So the trust owned the policy.
Yeah.
The insured was, let's say, Bob Jones was the insured. Bob
Yeah.
passed away, and
Mhm.
but he had the beneficiary set up to be the trust. So then the
Yeah.
300,000 would immediately pay out to the trust, and the trust would grow in value by $300,000
Okay.
if we structured it the correct way, which basically means that we, the trust, made sure to take out insurance policies on each family member. Um, and so each family member in the family who is, if this is a family trust, which many times it is, it's for the design of a family trust, each family member has their own policy, but each
Yeah.
family member also has their own directives within the trust to be able to utilize that. And maybe there's a small cash payout for, okay, we're going to take, there's, okay, we've got a family of five that one has passed
Mm.
away. Now there's four left. Well, what we did was we said, okay, well, each of the four are going to get a 10% payout of whatever that death benefit was. It's going to pay out at
Mhm.
300,000. So each family member is going to get a $30,000 contribution free and clear.
Yeah.
And that's those are the beautiful kinds of things that you can do with that kind of thing, is that you can go, okay, well, there's a 30,000 payout free and clear, but they can also keep it within the trust,
Mhm.
and disperse it in other ways. They can go, hey, we're going to pay this out, we're going to structure it so that it pays out kind of like an annuity, where they go, okay,
Yeah.
yes, there's a $30,000 payout, but it's going to pay out monthly over the next 5 years. So that basically what it's doing is it's paying out in small increments. So you're not getting huge taxable events with the payouts. Sometimes you can set it up so that those don't become taxable events. They just
Mhm.
become a simple payout with no income
That's yeah.
quote to it. So
Mm.
there's a lot of ways to structure it. There's a lot of nuance, and of course, we all know that the American Tax Code book is only about this thick. So it's a short read. The and so digging through to make sure that we're all following the right. I always suggest and tell everyone, make sure that you've got a great tax advisor, not an accountant, not a
Mhm.
bookkeeper, a tax advisor. Tax advisors typically understand the tax code really well, or they have a team that understands it really well, so that they can help you navigate the code and
Yeah.
keep yourself one in check so that you're not doing anything illegal, but
Mhm.
two, they can help you keep your tax liability as low as possible, so that at the end of the day you're owing minimal tax, if you owe any at all. and so
Exactly.
and so that's the goal, is we're trying to reduce our taxable footprint. That's the whole reason for building the trust. That's the whole reason for the infinite banking policy within it, is to reduce that taxable footprint, so
Yeah.
that you know, I'm saving on
100%.
taxes having to pay, you know, I understand having to pay taxes to the government, but, you know, last time I read my history book, taxation was theft. And so if we can avoid, you know, most of it, then let's do that.
Yeah. I wholeheartedly agree.
Legally and ethically. Let's do it the right way, but that's
Yeah.
the goal here, is to legally and ethically, not pay things that we don't have to pay.
Very true. So if we left that $300,000 in the trust,
Uh-huh.
could we then recycle it back into the policy to create an even higher cash value for the next generation, or higher cash value, sorry, death benefit for the next generation, or cash value to borrow against?
So yeah, I mean, ultimately, you could, there's multiple ways that can be done. A lot of times, what you would do is you would go, okay, who is, you know, who's next in line, or who's the youngest. You might go, hey, we're going to put, if you've got an LLC within your trust, and there's a
Mhm.
key person that's in your family who is the key person in that LLC, you might
Yeah.
take out a key man policy on that person, which will give
Okay.
you even more cash value. You may
Mhm.
say, hey, you know what? Little Johnny is 24 now, and he started his own business and he's doing really well. So we're going to go take another policy out on little Johnny,
Mhm.
and we're going to take that 300,000 and front load that policy, so that yes, it's still inside a policy. It's still very tax protected. It's got all the tax growth to it or I'm sorry, all the tax free growth to it, which is amazing. And so then you've got all that going on. Plus, now you've got the borrowability again of the 300,000. This is what,
Yeah.
guys, this is what banks and corporations have been doing for hundreds of years. if
Yeah.
if you're not familiar with the term bank owned life insurance or corporate owned life insurance, this is exactly how banks are making money in the billions and trillions, is because they own more, our big three: Bank of America, Wells Fargo, JP Morgan Chase. The reason that they're as large as they are is because every time they get a new employee, they take a bank owned life insurance policy out on that employee, and then they borrow against the cash value, and they send that money out into the world, and that money makes them money through mortgage lending, through auto loans, through individual loans, through all kinds of lending that they do in the banking world. And that money all comes back to them, and it comes back to them, it comes back to them. Well, if that person that they took the policy out on dies, then the cash value of that policy, or the death benefit of that policy, goes to the bank. So think about how many people have passed away with their
Yeah.
bank account still intact.
Mm.
And the bank owns a policy on them. So when they died, the bank now gets a $500,000 payout, a $100,000 payout, whatever it is that the bank decided to put in a policy on that person. They do it all the time. It happens every single day. Well, what we're
Mm.
trying to do with these trusts is build the same kind of structure within our own families. And sometimes it starts small. Sometimes you're in a position where you can start it larger, but you start where you can and you do
Yeah.
what you can and you build it. And over time, you begin to look up, and next thing you know, you've got a structure that is indestructible. I worked with just to tell a story and a caveat on this. I worked with a firm a while back who the firm was a financial consulting firm, and so what they would do is they would consult on these types of policies. We would consult on creating your own private wealth system, and we ended up bringing on a partner. While I was in the time that I was there, we brought on a partner who had he was the trustee of his family's trust.
Right.
And his family's trust was an old Bavarian trust. I mean, and I'm like an old European trust that's been around for decades, or I mean, probably hundreds
Centuries.
of years at this point. And through that trust, what happened was when he took over as trustee, his all of his family came to him and started trying to get their hands in the kitty, and
Uh,
everybody wanted their fingers in the pot. And what he said was, he said, listen, if you really want to take part in this, you're going to need to find a way to bring more value to the trust.
mm.
And so what everyone did was they started creating an influx of cash into the trust. Well, they started building these mechanisms that would pay back out, whether it was through they would buy cash producing, income producing assets.
Yeah.
They might buy gas stations, or they would buy, convenience stores, or they would buy anything that was an income producing asset. And they would take the income from that asset and they would disperse the profits back out to the people who had brought their money to the trust. And as a result, the trust now has more assets under management than you can even
Mm.
fathom,
Yeah.
but more partners than you can even fathom. At last count, I think my understanding was that there were 10,000 partners
Wow.
that were all partnered with this trust and all
Mm.
contributing in some way to this trust. And so the value that this trust was gaining was massive, and
Mm.
everything was private. So it was all done in the private sector, which is amazing because when you can find a way to get privatized growth,
Yeah.
then now all of a sudden you're eliminating you're eliminating Uncle Sam's willingness to get into your, or Uncle Fred or whoever, may the tax entities that be. you're
Mm.
you're privatizing your wealth, and you're creating entities that are structured so that they don't get their hands in those things. And the reason why they don't get their hands in them is because many of these policies have been designed for our senators and our congressmen, and they use them too. And they're not going to write laws that allow them to tax themselves.
Exactly.
And,
Yeah.
and because they don't, and we can utilize the same policies and structures. And so it gives us the ability to do the same thing without the repercussions.
Absolutely. No, it feels like a privilege to know this information because it's not mainstream information, right? Like,
It's really not, and it's becoming more so. We're hearing more about it. There's a few people out there in the world that are talking about it.
mm.
Garrett Gunderson is one that comes to mind. If you haven't heard of him, he's definitely one worth looking up. He's on CNN and MSNBC all the time talking money. Really
Yeah.
brilliant guy, but he is a firm believer in the infinite banking system. Robert Kiyosaki, who is the
Yeah.
author of Rich Dad Poor Dad, big fan of the infinite banking system. Donald Trump, the president of the United States right now, is a big fan of the infinite banking system, has been for years and years and years. It's not something that is new. It's been around for a long time, guys. People have been using these before savings accounts. So, history lesson here. Before savings accounts really started coming on in the 50s, 60s, and 70s. And they started coming on. And before that, people were using whole life insurance policies as their savings accounts. And that's where they would put their money, is in their whole life insurance policy. Guys like J.C. Penney and Walt Disney utilize these policies to keep their businesses afloat or to start their businesses back in the day. And so in the 50s and 60s and 70s, what happened was the banks and the Fed began to notice that nobody's bringing their money to us. Everyone keeps taking their money to the insurance companies.
Yeah.
So we've got to fix this. And so what they started doing was the banks started offering these really high interest savings accounts. And maybe you remember them from the early 80s or the late 70s. You remember these 6, 7, 8, sometimes even 10% interest rates on these savings accounts. And so not even a CD or a money market account, just a standard savings account. Okay, well, I'm going to put I'm going to put $10,000 in the savings account, and it's going to grow massively because it's got
Mm.
10% interest on it. Well, slowly over time through the 80s and the 90s, we watched that number dwindle, dwindle, dwindle. So that now
4,000.
today, a standard savings account at the bank, 0.7% interest over the year. Maybe you get 1% interest over the year if you get a really high powered one, but you're seeing zero interest growth on a savings account. And it's almost as if the bank is telling us something, you know, but we've been so programmed over the years that you put your money in savings, that we've forgotten that the original savings account was one of these whole life insurance policies. Because
Mm.
when you start one, it's structured the right way. You're not only getting the high powered savings with a growth that's 4, 5, 6, sometimes even 7% year over year, you're also getting that death benefit. You're getting the borrowability that you can use for opportunity funds. You're getting a lot of things that you don't get with a normal savings account. And I think that people are missing that. And that's the one thing that people need to understand, is that
Mm.
it's so much more than just a life insurance policy. I mean, that at its bare bones minimum, that's what it is, but it's so much more than that. And as we try to turn this Titanic of a ship around, where we're really trying to turn the tide on, in my mind, it's financial acumen and financial education. The world has been, especially in America, and I think as America goes, so the rest of the world tends to follow. America has become the land of consumerism. And
Yeah.
hey, don't get me wrong, I love to consume. I'm looking at you right now through $1,000 camera with two really expensive monitors and a really overpriced computer and this big giant fancy microphone and my big fancy mic. So like, I love to buy stuff too. Don't get me. I'm not saying anything that we don't know. We all love to buy stuff. What's happened is that we've forgotten how to save. We've forgotten how to create opportunity funds. See, America was built as the land of opportunity, and slowly but surely we've become the land of consumerism, and opportunities are becoming less and less. And as the
Mm.
opportunities come up now, the people with the money, and I mean, for most of America, the people with the money, we're talking about the 1%, are the ones that are capitalizing on all the opportunities, because the rest of us have just
Yeah.
become consumers and we've forgotten how to
Yeah.
put money aside for those things. This policy, these whole life insurance policies, these infinite banking policies are designed so that you can start creating an opportunity fund again, so that you can begin to capitalize on the opportunities that come your way, so that you can create more income for your family, a legacy for your family to not only remember you by, but to continue to grow throughout the generations. So,
Yeah. It's so true. And when you're creating something like this, I mean, I heard a really good expression the other day, is you actually die twice. Once when you physically die, and then the second time you die is when your name is spoken for the last time.
oh,
You go and create something like this, it's a legacy. Generations will appreciate you uh, way, way, way down the line, because you've done something for them that's, you won't be forgotten. They might not know what you look like, but
right.
be that gratitude there. So yeah, it's an amazing gift to give your family and your legacy. Um, so just one more thing I want to touch on before we wrap up is I work 95% of my client base is people from the US, right? But 5% are people who know about the power of these types of trusts that I set up that have no automatic tax filing requirement, amazing asset protection,
Right.
avoid probate, avoid estate taxes, um, and particularly because the uh, tax authorities in other countries are getting really, really difficult to deal with. But many of them, because of the power of the internet, have heard about infinite banking and whole life policies, but they're not available in other countries, right? So, what can we do to help people that, obviously, we're going to need a trust that's set up in the US, so I can take care of that part. That's no problem. But how do we set something up so that they can benefit from this type of policy?
So there's a couple of things, and I won't go too off into the weeds on this. I'll try to keep it pretty simple. Couple of things is, if you are based in another country, in order to capitalize on a US based insurance policy, you have to have what's called an insurable interest in the United States. Now, if you as an individual, typically the insurable interest is a person. So you have to be a person of interest somehow in the United States. There's two ways to do that. Number one is to own property. And there are many, many ways to go about slicing that pie.
Mhm.
Especially if the property is inside your trust, there's a lot of ways to slice that pie so that it becomes a bigger conversation. But owning property is one way. The second way is owning a business. If you own a business and you are a key person in that business and in that business's ability to grow, then that makes you a key person, and then we can structure a policy properly around
Yeah.
that. And so those are the two ways. And if I can just hit on both really quickly, I'm actually learning quite a bit about both of those avenues right now, whether it's a business acquisition or a property acquisition. And oh my gosh, y'all, the opportunity that's available is unbelievable right now. With baby boomers aging out and
Mhm.
really selling off their businesses. I mean, we're seeing business sell-offs like we've never seen before. There's sometimes you can get into a brand new business, you can get into a business acquisition for almost zero down.
Yeah.
So it's just finding the right businesses. Property is the same way. There are so many ways to get into owning a property, that are minimal cost to them, and so there's always opportunity there to get into both of those things, and then we can
Yeah.
begin to look at how that fits into the bigger picture of the infinite banking policy inside the trust.
Yeah. I mean, that's the great thing about the US. If you're not from the US, actually setting up an LLC to operate a business, it's really easy. And the tax implications, you're not, you, the doesn't create any tax implication for you as a non-US person inside the US because it's a pass-through entity.
Right.
The tax goes back to your home country. So it keeps things really simple. So it's actually a good foot in the door. The only other thing is you have to physically go to the US to go and get the medical examination done, right?
That is the other piece of that puzzle is, yes, you'll have to come over and see us.
Yeah, which is, it's not a bad thing. There's plenty of amazing, beautiful places to visit. So
Truly, truly there is.
yeah.
Truly there is.
Well, Chad, thanks so much. It's been really eye-opening, and yeah, I just love the way you explain it all and make it so easy to understand. And yeah, I'm
Well,
really
I this the conversations that you and I've had, it's always been exciting, and I love seeing where it's going, and so to be able to partner with you in this and grow, help each other grow, I think is outstanding. So I'm looking forward to the future.
all right, Chad. We'll talk soon. Take care.
Sounds great.
Bye.